Okay, it's 11 o'clock. Let's get going because there is a lot to get through, as I've said already. So I'm going to be doing some news first. Then Andrew McHattie is going to talk us through what happened during May, and then I've got Fotis Chatzimichalakis of Impax Environmental Markets, and he's going to be telling us all about that trust. So news first. So four things that I pulled out. So foresight environmental infrastructure first. And as always, you can see the big disconnect between the share price of the NAV that happened when interest rates started to go up, more or less. But you also see this sort of slipping NAV as well, which I think is unhelpful. It'd be nice to see that make a turn soon. Discount has narrowed a little bit. You can sort of make it out on that chart. It's still 27.8%, which is too wide, and that means that the yield is very chunky, over 10%. So they have been doing a strategic review about what to do about this. They've thought about and rejected things like managed wind down, doing some kind of M&A, just carry on as before. And what they've decided to do is refocus what they do so that they're going to focus on basically what they call core infrastructure. And what that really means is things that are capable of chucking off long-term predictable cash flows. So what they're getting out of is the more innovative stuff. So they've got the fish farm in Norway and the greenhouse where they're growing cannabis in the UK. So that's the kind of controlled environment stuff. So they're going to come out of that. And they've also got compressed natural gas stuff, and they're going to sell that too. So both of those businesses are maturing. The first of the fish harvests is going to be in July, and they announced earlier this year that they've done a deal with Refuels, which will expand the CNG business and put it on a kind of firm footing. So when the exits will be, don't know, but that will happen, and then it's a question of what they do with the cash. So I mentioned the NAV going down still. It went to 106.5p over the first quarter. I'll show you a breakdown of what happened there. They have announced a new dividend target for this year, up 2%, which is good. And it helps a lot that the dividend is very much covered by cash flow, so 1.32 times. So that extra cash frees up stuff to do with stuff within the portfolio and also stuff for buybacks and things. And they've got a buyback target of £30 million now, and they've bought back 19.2 million of that so far. We'll get some proper results on 24th of June, but in the meantime, here's the kind of breakdown of the Q1 NAV move. And you basically, the idea is these kind of other movement stuff offsets the dividends, and then you get some other bits and pieces that help the NAV sort of move up a little bit, but stuff's gone the other way. So the power price moves have been affecting everybody. The whole argument for FGen was that it's not much exposed to that, but getting rid of things that aren't affected by power prices will increase the sort of exposure to power prices going forward. Hopefully we've taken most of the pain already, and that will mean that they catch the turn and we'll get an uplift from that, but we'll wait and see. The portfolio didn't perform very well during the quarter, and although it seems like we've had sort of in the sunshine one end apart from the last couple of days, it wasn't sunny in the beginning of the year, and actually they underproduced what they were expecting in the solar farms, and also it wasn't really windy either. The thing that's sort of hopefully a one-off is a maintenance hit. They've decided that they need to spend more on the anaerobic digestion plant, biocollectors thing, and convert biogas. So that's taken off 0.6p, 0.7p rather. And obviously the buybacks are helping to push the NAV up, so that is offsetting some of that, which is helpful. JP Morgan Indian, that chart looks great really, because it's be sort of going up in a straight line. Obviously there's a big discount, obviously that discount has been narrowing, but it has been lagging its peers by some margin for a long time. You can see the discount's now coming to 6.8%. That's really because of what's been announcing. Now, if you remember, I talked about this a couple of weeks ago. Just to reiterate, you can see that, look at the 1 year NAV returns there. It is the worst performing fund over 1 and 3 years and 5 years, and so 10 years. It's really not very good, and I think that's really what the discount is all about, nothing else. But nevertheless, they are pushing on with existing management strategy, and trying to narrow the discount by buying back stock mainly. So go back and look at the show on the 23rd of May if you want more detail on that. But what we've announced today is the details of the tender offer. So it's a 30% tender. The assets get hived off into a realisation pool, and that gets turned into cash. It bears the costs of that, which are about £930,000, which to me just seems enormous. We never really see a breakdown of where this comes from or who gets paid what. I think shareholders should start asking these questions, to be honest. That works out at about 0.4% of NAV, so not the end of the world in terms of the hit to the NAV. To participate in this, you need to be on the register on the 10th of June, obviously early next week. There's a meeting to approve it on the 8th of July. I expect it to be a foregone conclusion. And also, because you've put your tender forms in and everything else by then, we'll get the results of the elections out on the same day. I don't think there's any way this is going to be undersubscribed, so the 30% will probably definitely happen. They'll turn into cash and distribute that as soon as possible afterwards. There's no real clue as to how long it will take, but I would think the portfolio is quite liquid, so it should be quite straightforward. Baker Steel, I wanted to mention. It's not very big, this one, but it's interesting, and it sort of falls in this category of funds that would need to keep going because they're doing something different. So it's on a whopping discount, 38.2%, because it's got a slightly unpopular sector in terms of commodities and natural resources, and because it's got a lot of unquoted stuff. But nevertheless, I think that discount is overdone. So what they wanted to reiterate, the announcement they announced yesterday, is that 2 of the projects that they're exposed to got put onto the EU strategic projects list. That should be really good news, because it should mean it's much easier to get finance for them. So the trouble with all of these small mining companies is you can have amazing resources and then you can't get the money to actually develop the mines. This actually looks like it could be a game changer here, so that's obviously a big tick in the box. But the far more impactful thing is the fact that Futura Resources could end up being bid for at a 42% premium to the current carrying value. They're going to revalue it at the end of June. It's not guaranteed that they'll mark it up by that much, but the reason for that is that the coal price has been coming down, which has obviously affects profitability and stuff. But nevertheless, that could be quite impactful on the NAV, because that is a 32% position in the fund. So you can really see how that could move the NAV and really shift the share price. So one to watch out for there. They've got a royalty on the coal production too, so they're going to keep that whatever happens, and that's obviously another big tick in the box. So interesting one. And then lastly for me, I think Empiric Student Property, which has sort of been hanging around for ages. When GCP Student Living got taken out, I thought this one would be next in the queue, and it didn't happen. But now we do have a bid for it from Unite. You can see the share price has gone shooting up. You can see the Unite share price has come off, and that is just merger arbitrage going on already, I think. So the Unite proposal is 30p in cash per share plus 0.09 Unite shares. Before this happened, the Empiric share price was 97p. It had already gone up on the back of some decent figures. The NAV though is 119.6, and on the basis of the current Unite share price, it only values at 105.1. I think that discount's far too wide. The board are talking to Unite. This is not a recommended bid, so the due diligence has started. Obviously, Unite might argue that then NAV is overvalued, but assuming it doesn't, it's also possible that somebody else comes in and we get sort of like bidding more with this. But it has all kicked off, which is good. So, well, good for me because I'm a shareholder. So that is enough from me. I'm now going to bring in Andrew. So, good morning. I'm going to give...
Yes, good morning, and that was great. Thank you very much, James, and good morning, everybody. I'm going to talk about what happened during May, which was a really interesting month, actually, very much, I think, determined by geopolitics, because you'll remember, of course, that in April, markets took fright. That was the tariff tantrum, and then actually in May, when those tariff proposals were obviously scaled back quite rapidly, so markets recovered. So actually, we saw some pretty good rises across the sector during the month. And I think this really reflected the return of risk appetite. That was the main thing. So you can see actually here, there's quite a lot of growth capital on the list, including Augmentum FinTech, which I talked about here in April, because I thought that was undervalued, especially because most of its activities were in the UK and Europe. So there's quite a lot of growth capital here, and actually a good mix of things with some good double-digit gains. The ones I'm going to talk about are those two at the top, which I think were exceptional and both gained more than 30% over the month. But clearly that was about risk appetite. On the way down, the fallers were much more muted, as we would expect. Not many falls here, over 5% or so. A couple of special situations, such as Third Point Investors, which I think disappointed many people with its proposals basically to become an insurance company. RTW Biotech has had some specific issues, and there's a bit more renewable energy on there. One factor here, which is quite important, is the foreign exchange headwind. Quite a lot of dollar earners are on the list because they've been hurt actually by the strength of sterling against the dollar. But what I'm going to talk about here is the biotech and healthcare sector, which was very weak over the month, and that's really reflecting a continuing trend, which I'll talk about. So first of all then, let's look at the good news, the rises. Seraphim Space was top of the list over the month with a gain of almost 40%. So a really big rise here. Now the chart here is a 5-year chart, deliberately long-term, to show you how this trust has evolved. And it did start actually as a very popular offering, really bringing something completely different to the investment trust sector, and started at a good premium. And then in common with so many other things, that the price fell away, fell to a discount. You'll see here that the NAV has barely moved over these years, which in some ways is not a great recommendation of it, but actually it just demonstrates that they're not moving the NAV around too much here. There's a few minor revaluations or devaluations, but not a lot going on. So it's really to do with the share price, which has obviously been depressed as people have moved out of growth capital, and because interest rates rose, that meant that these longer duration assets where you're waiting to get your returns in the future became less valuable. But the discount did seem extreme, actually, at around 50% at one point. It's come in a lot now, so there's been a good recovery in the share price. And I think a lot of that has to do with the trust actually really reiterating its recent messaging, which has been quite strong. I mean, I've talked about this before, and it's really that Seraphim has been out on the road reminding people that it's heavily exposed to the defence market, which of course now with Europe really ramping up its defence spending has become a hot sector. And here actually, you know, the trust is involved with satellite imagery, with secure communications, with drones, all sorts of aspects of modern defence architecture which are based in space. So the trust is finding itself, I think, increasingly well positioned here, and it has said that defence spending accounts for 78% actually of its portfolio. So it really is a kind of stealthy way of playing the defence theme, I believe. And it's said here that, again, 7 of its top 10 holdings are really about the defence industry. That's how they're getting their revenues. And revenues are ramping up. I mean, I think there's been quite a lot of good news actually here from the portfolio, including its large holding in a company called ICI, which is all about the satellites. So I think actually the outlook looks pretty good here, but now the discount has narrowed all the way into 28%. I mean, it's still wide, of course, but it's a lot better than its widest point of 52. I think the question arises of whether these shares can maintain that momentum or not, or whether they really need a bit more news to come through. And I was thinking that earlier this week, and then actually there was a broker's note from Stifel as well that made the same point, that maybe in fact for the shares to move on from here, they need a bit more actual direct news flow, so perhaps some news of some kind of realization from the portfolio. Nevertheless, it's really good to see this recovering because I think it's an interesting asset, and I'm very glad it exists in the investment trust sector. A slightly similar story, but actually I think at a different phase here, from Hydrogen One Capital Growth. This trust is obviously, as the name suggests, focused on the hydrogen industry. Again, started well. This is another 5-year chart. Shows it stood at a premium in its early stages. And again, without much change in the NAV, the share price has really dropped away as people have become a bit more skeptical and they've really wanted to look at other things, maybe things that pay a dividend. So the discount that opened up here really became extreme. And when I produced a statistical supplement for my subscribers recently, this was the trust that had the widest discount of all, actually, at 77%. So really very extreme. And in part, that's based on, I think, some disappointment about the pace of growth in the European hydrogen market, in fact, in the UK in particular. And I think the trust has really struggled to make a powerful marketing message that appeals to investors. It's not managed to achieve the kind of exits it's been talking about for quite some time, actually, on management meetings. The managers have been saying that actually corporate advisors have been engaged and they're expecting sales or IPOs to come out of that portfolio, but those haven't happened yet. And so I think actually that's now led the board to think about how they are going to narrow this discount. And so the board has issued a statement saying that they're considering a wide range of options to deliver shareholder value, with confidential discussions underway with third parties. Now, that's about as vague as you can make it, I think. I don't know what that means, and I think it's very difficult to discern. But I think it does mean that the current status quo may not be maintained. And my sense with this certainly is that with the shares on a roughly 70% discount, that's not a sustainable position. And the trust that is too small really to be buying back, and it needs that capital, of course. It can't raise fresh capital to invest in its portfolio. So I feel this trust looks too small. The market cap is only £34 million now. And I think it's really interesting. I definitely feel something is likely to happen here. I just don't know what it's going to be. So the shares have picked up actually from a low of about 20 pence to 26.4. So it's quite a significant move, but with the NAV up at around 89 pence, there's a great deal of scope here for further movement. So that could be one to have a look at. On the downside now, let's move to the healthcare and biotech sector, which has been pretty depressed actually, really because of events in the US. And if you look at the news headlines, they're all dreadful actually of late. There's a lot of talk about what's happening with the US healthcare department, of course. When Robert F. Kennedy Jr. was appointed as head of US healthcare, that caused a lot of ripples because he has very unconventional views, let's say, quite controversial. He's anti-vaccination. He has very distinct methods of looking at the sector, and that's caused a great deal of regulatory uncertainty. So there are plenty of headlines actually about how the political situation in the US has really hurt the biotech sector. And we can see that in the stats. On the left here, we have the 8% fall in the NASDAQ Biotechnology Index over the last 6 months. And if you compare that to the S&P 500 in the middle or the NASDAQ on the right-hand side, I mean, those haven't been great either, but you can see the much, much bigger fall in the biotech sector. So it's been a difficult place to be, actually, and a difficult place, I think, especially for London-listed trusts. And this is the sector here, ranked by the 6-month NAV return, with the worst ones at the top. And you can see that apart from Syncona, which is basically unlisted stocks that it probably hasn't revalued yet, it's been terrible. It's been a really, really awful time. And this is a combination, actually, of these falling US prices together with the foreign exchange headwind as well. So the Biotech Growth Trust there at the top actually had terrible results. For the year to 31st of March, its NAV was down 24.4%, and that was compared to a 6% drop in its benchmark. So it doesn't seem surprising to me that there's quite a lot of talk about possible intervention here from arbitrageurs and others. You'll probably know that Saba has taken a 5.4% stake in Worldwide Healthcare Trust, and it wouldn't surprise me at all if the Biotech Growth Trust also came under pressure, not really because of the discount, which is only 9.4%, and the trust has bought back actually nearly a fifth of its shares over the last year, so it's really been very active with its buybacks. But nevertheless, I think that trust now has a market cap of under 200 million, and it's looking a bit small, a bit vulnerable, and its performance has just been terrible, which is largely, I think, it's not due to any issues with the management. It's just it's targeting mid and smaller cap trusts that are early stage, and those have been very much out of favour. It could well be actually that with some shift in the political landscape, some softening there, and perhaps I think a return of some M&A and the chance of IPOs, we could really see this trust coming back. But for the moment, this whole sector is extremely depressed. I will just talk about M&A just for a moment. This is my last slide. I do think that, there have been some big deals, and there's a couple here that the FT have reported on. So big pharma companies are still buying small biotechs, and they have to keep doing that because they're not developing these newer drugs themselves. But I do think actually that the biotech and healthcare sector has a lot of latent value inherent in it, and I think that could be released actually with a bit more M&A. There's a lot of talk about that increasing. And this is really where I think all of these things tie together. I think the resurgence in growth capital and the potential in the biotech sector all hinges on the health of capital markets. Because actually, if those open up a bit and we see more IPOs coming, that's going to be good for those growth capital trusts. And if we see more M&A, I think that could be really good actually for recovering value in the healthcare and biotech sector. I think there's a good chance of both of those things happening in the second half of the year. So I think if capital markets start to look a bit healthier, then we could really see a big improvement in quite a lot of interesting areas. Okay, thank you very much. That's it from me.
Brilliant. Thank you very much, Andrew. Very interesting as always, and actually some things that I've been thinking about as well. So I'm now going to bring in Fotis. So good morning, and thank you very much for doing this again.
Morning, James. Nice to talk to you again.
So I'm going to let you drive. Tell us all about Impax Environmental Markets, please.
Absolutely. Let me just okay. So morning, everyone. Nice to be talking to you as well again today. So I'm gonna give you a bit of an introduction on Impax Environmental Markets, explain to you what the trust does, what we have been up to this year, and then open up for questions. So if we start with this slide, just a quick reminder of the investment thesis behind IEM. So in a world with finite resources and constant demand for higher living standards, we believe that companies enabling the cleaner and more efficient delivery of basic needs like water, food, energy, but also companies that are tackling and mitigating risks like climate change will grow earnings faster than the global economy. And in the long term, that should drive superior stock returns. So IM is really all about giving investors pure play exposure to this very attractive growth opportunity. And what I mean by pure play exposure is that for a company to be eligible for IEM, it needs to have at least half of its revenues coming from environmental markets. If we go to the next slide. So obviously the past couple of years, the world has been a very volatile place and performance has been a bit more challenging. But I think it's important to appreciate that and remember that IEM has been going on for about 25 years now. And the problems that it was designed to address, haven't really gone away because we have a Trump administration in the US or because AI has been monopolizing interest in markets for the past 2-3 years. So sadly, we still have global warming. We have, more and more extreme weather events that are happening more frequently, and they are more expensive to deal with. This is putting pressure on our water and energy networks. I mean, it's pretty scary to think that 25 years from now, half of the world's population will have to deal with some sort of water stress. So there is massive need for investment to address these issues, and this creates opportunities for the companies that provide the solutions to these problems. So, just summarizing the slide, I would say we are investing in not nice to have policy dependent products, but really in mission critical solutions that the world absolutely needs today. If we go to the next slide, in terms of key messages, I would say, first of all, that the drivers behind environmental markets, are as strong as ever, and that is supporting the thesis around superior earnings growth. Second is that for the past 3 years, we've been operating in a market that was all about mega cap tech, and small and mid cap companies have been pretty much as out of favor as they have ever been. So this is obviously a very fragile situation, and as market participation starts to broaden out, and we do see that already happening this year, I would say there are very strong diversification benefits in looking at a trust like IEM that has more than 99% active share versus global equities. Uh, Message number 3 is that with small and mid-cap companies being out of favor, the portfolio has suffered from a very aggressive derating versus global equities. So the relative valuation of the portfolio is at historically low levels. And on top of that, there is an additional 10% discount to NAV at the moment. And then my final key message is that we do have a very active and engaged board, that really provides constructive challenge, is a very good sounding partner. So that also makes a difference. So these were some key messages for IAM. If we then go to the next slide, I think this is also an important slide because it really illustrates the core of the IAM investment thesis. So you can see on the right hand side that over the long term, IAM has really delivered the superior earnings growth versus global equities that I have been talking about earlier. So this is really the thesis playing out. But of course, nothing is a straight line. So in the past 3 years, we have had a once in a lifetime disruption of supply chains after the COVID boom. And also we've had outsized earnings growth by mega cap AI companies that are not really in the opportunity set for IAM. So putting these two things together means that on a 3-year basis, our earnings growth has lagged global equities, and that has also affected our 5-year numbers. But the benefits of IM having been around for about 25 years is that we have seen before our markets falling out of favor. And what tends to happen is that our portfolio companies eventually re-establish themselves as high quality businesses with superior earnings growth. Also, something that's interesting to think about is that on 3 years, our earnings growth has been just below ACWI, just below global equities, but at the same time we have really suffered from a very violent relative derating. On slide 8, you can see the long-term performance figures for IEM, very numbers heavy slide. So let's go to the next one to see what has been happening this year. This is the year-to-date performance to the end of May. So we're about 2% behind global equities and about 1.5% ahead of the ET100. The ET100 is a proxy, if you will, for environmental markets. So what we're seeing this year, I would say, it's not all about US and it's not all about mega cap tech anymore. Of course, there's still a lot of uncertainty, volatility. Look, for example, what's happening in the US with tariffs. Every day is a different landscape. So that is, I would say that's not helping a SMID trust with a pro-cyclical bias like IEM, but we have actually held up pretty well in this volatility. So if we break the year in 2 quarters, Q1 we saw strong performance in Europe, but it was, if you look underneath that headline, performance has really come from energy and from aerospace and defense. So again, not really what's in the universe for IEM. So in Q1, we were 3.5% behind ACWI, but we have actually been gaining ground in the second quarter, where we have signs of broadening market participation. We've had a pretty strong earnings season. So in the second quarter so far, IEM is about 1.5% ahead of global equities. What's interesting to talk about is, what have we been up to this year in this very volatile environment? So I would say after this period of weakness, and particularly after the fourth quarter of last year, that was, we had very weak performance at the time. We were in a situation where share prices had come off. There were a lot of opportunities out there. So we thought that this was a good time to try and use this weakness as an opportunity and come out on the other side with the best possible portfolio. So we looked mainly at 2 areas of the portfolio. The first one was some of our more vulnerable, fragile business models that we did not have a lot of conviction in. For example, some of our renewable energy equipment providers. And the second was companies where the thesis had played out, valuation was a bit more full, upside was not looking as attractive anymore. So we, with so many opportunities out there, it did not make sense to keep holding on to names like that. So that process led to us exiting 14 positions this year, so very dynamic management of the portfolio, and establishing 9 new positions in areas that we're very excited about, we have a lot of conviction in. So I'm highlighting here on this slide in the middle 3 of those areas: electrification, digitalization, and climate change adaptation. So again, these are multi-decade issues, and we have a lot of companies in our opportunity set that provide solutions to these problems. And then in terms of investment styles, where have we been allocating to? I would say it's a bit of a mix of some more defensive business models and some more attractive growth opportunities. So all that activity ultimately resulted in a very high conviction portfolio that is more consolidated, has better quality metrics, and similar valuation and risk characteristics. If we go to the next slide, you can see the top 10 for IEM. So again, I would say it's a mix of some more resilient companies like Waste Connections and Clean Harbors, which are both waste management companies. Then we have, excuse me, some companies with more self-help potential, more idiosyncratic catalysts. I mean, the top holding here, DSM Firmenich, is a good example. It's a natural ingredients companies, and we had DSM merging with Firmenich a few years ago. So we're still early on in some of the cost and revenue synergies being realized. So this is one of these situations where 1 and 1 equals more than 2, and there's a lot of value creation potential. And then the third category in the top 10, I would say some more attractive growth opportunities. Trimble is a good example. It's a software company that's digitizing the construction industry. So construction is the least digitized sector out there today. Massive inefficiencies, a lot of labor shortages, a lot of issues that make the prospects for the software solutions that Trimble provides pretty attractive. So that's what I would say on the top 10 mix of different sort of types, profiles of holdings. The next slide is looking a bit at our positioning versus global equities. So on the top left, you can see the market cap profile. So very much a SMID trust. 70% of the companies in the trust are below $20 billion market capitalization. The median company in the trust has a 9 billion market cap. So again, with small and mid caps having been so out of favor for the past 3 years, we think this is a pretty interesting time to have that SMID bias as we look ahead. Then on the top right, you can see the key GEEKS sectors for the trust. Industrials, IT, materials, and utilities are the key ones. Bottom left, you can see the split between cyclicals and defensives. Just reiterating, we do have a pro-cyclical bias, but we're actually pretty balanced between defensives and cyclicals. And then finally, bottom right, you can see the regional breakdown. We do have an overweight in an underweight, in North America versus global equities. So again, with more signs of broadening market participation and all these sort of thesis in the market out there that we could be near the end of the US exceptionalism, this again might not be a bad place to be. And then I'm going to finish with this slide, which looks at earnings growth and valuation. I started by saying the thesis behind IEM is the delivery of superior earnings growth versus global equities. And here you can see on the left-hand side the expectations. These are consensus expectations, so to be taken with a pinch of salt. But you can really see that the portfolio is expected to deliver faster earnings growth than ACWI. So, that is in line with the thesis. And at the same time, if we look at valuation, relative valuation to global equities at the bottom right, you can see that it is really at historically low levels. The absolute valuation of the trust, which you can see at the top right, is in line with history, but it's important to appreciate that this is, there's been a very big mix shift within the trust for the past 5-7 years. So today we own a lot of software technology companies, higher multiple sectors that offer more resilient characteristics. So absolute valuation in line with history, but relative valuation, pretty much as low as it has ever been. So I will pause here and I will open up for questions. Back to you, James.
Brilliant. Thank you very much, Fotis. That's really good. We've got a good cover of the trust there, I think. One question that popped up early on here that I think is probably worth exploring. So, has the definition of what constitutes an environmental stock changed since you launched it?
Yeah, I would say no, not at all. So, going back to what I said at the beginning, this is all about identifying the solution providers to the more efficient delivery of basic needs and to mitigating climate change. All these sort of what has happened in the past sort of 3-4 years is that we've had this, as you said, the woke agenda. We've had the politicization of the term ESG, which is a very misunderstood and misused term. So, IM is all about investing in markets with superior earnings growth. It's all about risk-adjusted returns. It's all about performance. For us, ESG is part of our fundamental analysis on a company. It's a sign of corporate resilience. It helps with risk management. But the term ESG investor, I don't even know what an ESG investor is. It means 100 different things to 100 different people. So yeah, again, IM is all about investing in companies providing solutions to multi-decade problems that the world faces today, like water scarcity, food scarcity, need for more electricity.
Thank you. Now, there's lots of questions about Trump, not surprisingly, probably. Um, so to try and break this down a bit, um, I think firstly, how sensitive is the portfolio to what's going on in the economy generally? So, if he triggered a recession in the US, would that be a problem, or are these sorts of things that grow regardless?
Yeah, so I would say if we had a US recession, that would be bad for equities. There's no question around that. But there's a few nuances here. So first of all, what would be more vulnerable would be the part of global equities that has been, doing better in the past 2, 3 years. And again, goes back to my point that we have had a super concentrated market, and that is a very fragile situation to be in. So, for a trust like IEM, where we have our Schmidt bias, we've had some challenges, I was saying before, coming from a disruption of supply chains, there is valuation is already at pretty low levels relative to history. So that's point number one. Point number two is we have been trying to position the portfolio to some more resilient business models. I mentioned that when I was talking about activity year to date, have added companies that should behave more defensively through the economic cycle. And then my third point excuse me, would be that if you look at some of the more cyclical exposures in the portfolio, like construction, for example, we have really taken profit in some of these names. If you go to the beginning of the year, construction was high teens, just below 20% of the portfolio. Now we're much closer to low double digits. Automotive, another very cyclical sector, is less than 3% total exposure for the portfolio. So we have been trying to take action across different sort of fronts. Yeah, that's what I would say.
Brilliant, thank you. So then the next part of it question is obviously under Biden we had a Inflation Reduction Act, but which is obviously really all about driving things like climate change and spending and that sort of thing, and they seem hell bent on reversing a lot of that. Does that have an impact?
Yes, so that's another thing we have spent quite a bit of time trying to understand. Where is the policy sensitivity in the trust? And I would say it's really concentrated in two areas, renewables and automotive exposure, electric vehicles, basically. And you see that in the news that comes out of the US, what has been getting the most headlines are, subsidies for renewables might be, get ramped down much faster than people thought. Tax credits for electric vehicles. I mean, we've all been following the online conversation between Trump and Musk yesterday. So this is really, what's at the eye of the storm. And these are two areas that we have very limited exposure in IEM. That's actually a common misconception. People think of environmental markets and IEM as a renewable energy trust. That could not be further from the truth. So renewables today are about 6-7%. Automotive is another 2-3%. So let's call it about 10% that is more sensitive to these policies that Trump seems to be pushing forward. At the same time, if you think what is Trump all about, it's about more infrastructure in the US. It's about industrial footprint getting re-established in the US. So our companies, companies that we have a lot more exposure to in energy efficiency, in water infrastructure, in sort of grid infrastructure, waste management, are all companies that would benefit from this pickup of industrial activity in the United States. So I would say it's actually a lot more positive than the negative headlines suggest.
Great, thank you. And then one more on this. I know we're sort of stuck in the rut here, but on tariffs, do
Yep.
tariffs make a difference to some of your companies?
Tariffs definitely create a lot of noise. Again, as we said before, the tariffs regime is changing every week pretty much. So we are trying not to make any, knee-jerk reactions. But what we have done is, again, systematically go through the trust and think about where is the impact in the portfolio. So I would say we do have, some companies that are negatively impacted by tariffs. These are some of the more, cyclically exposed companies. Automotive is a good example. So yeah, we do have some companies in that category. That's, let's call it, about 10% of the trust. But then we have, quite a few companies that are, you know, a lot more resilient, a lot more defensive business models. For example, some of our water utilities, some of the waste utilities, these should be a lot more insulated. And that's about 30, 40% of the trust. Then we have, a similar level of exposure in companies where tariffs will create noise, undoubtedly, but, at the end of the day, these companies will be able to deal with that. And, it's not that long ago that we've had completely disrupted supply chains after COVID, and companies again had to adapt, had to be very flexible, and they did a very good job. And I think that that experience is going to be again very useful for what happens now with tariffs. So I would say tariffs create noise, but ultimately, I feel companies in IM are well positioned to deal with that.
Okay, thank you. Then looking at sort of changing the geography a second. So China.
Yeah.
So have you got exposure to China in the portfolio? And obviously that they seem to be spending a lot of money trying to decarbonize their economy, and things like solar panels and stuff they dominate. Are there industries in China that are interesting from that point of view?
Yes. So I would say the single most attractive industry that, where China is really ahead on a global basis is energy storage with contemporary amperex technologies, with CATL. So this is really the global leader in batteries, in energy storage, across chemistries, across applications, whether we're talking about electric vehicles or stationary storage. So this is really a standout. So, and that is a company we do hold in IEM. So that's definitely a very sort of higher conviction holding. I would say other areas in China, there is definitely some interesting automation companies, and we did have an investment that we have now exited that was active as exactly in industrial automation, had a bit of exposure to the emerging supply chain of industrial robots, humanoid robots. So definitely some interesting cases there as well. But really, energy storage and cattle stand out, I would say, in terms of our Asia, in terms of our China exposure.
Brilliant, thank you. Now, thinking about this slide, what's been going on here, and a bit about this derating that's happened. Some of that must be linked to interest rates going up. And I know we've seen very long-term interest rates going back up again, but at the same time we've got interest rate cuts at the short end.
Mm-hmm.
And should that be feeding through into valuations, do you think? If nothing else was going on, which is this sort of static period, would you be expecting to have a re-rating now?
Yeah, I would say we definitely had an impact from interest rates staying higher. That impact was more evident in our renewable energy companies, our project developers mainly, where a lot of them now trade at valuations below the value of their operating assets, which doesn't make a lot of sense. So, where we are now, you did mention, in the long end of the curve, interest rates are going up. There's a bit of uncertainty around debt at the moment, sovereign debt. But, in the short term, sort of where we are today, I would say, interest rates are probably, the move is expected to be eventually ramping down. So that should definitely be helpful for some parts of the portfolio. I wouldn't say that the case of IAM is that it's going to re-rate. It's about delivering earnings growth, but we do have some more interest rate sensitive sectors that would benefit from rates eventually coming down.
Okay, brilliant. Let's go back to the top 10 holdings for a second. I've got a specific question. Can you tell us a bit more about Darbar India, please?
Yes. So this is an India company, as the name suggests, and it's active in ingredients that end up in products like beverages, nutritional supplements. So, and it's all about natural ingredients. They have a big sort of Ayurvedic background, all about natural ingredients. So it has this, pretty interesting exposure to India, of course, to the Indian consumer, where there is definitely, we've seen higher spending power over time. There's of course this massive volume potential. So that's sort of an attractive characteristic, an attractive end market exposure. It is a dominant company in the country, so it's really one of the few that have such strong brand power, quite a broad offering of products. So that is makes a difference when you approach the sort of endpoint sellers, that you can offer them a lot of different products. You occupy more shelf space. So yeah, there's some interesting dynamics. There's been some challenges recently in India with weather being extreme, and that's impacting consumption of certain end markets, certain geographies. We've had an emergence of e-commerce, so again, that's changing the landscape a little bit in these in these kinds of products. But ultimately, Dabur is one of the leaders in this space in India.
The other stock that's specifically mentioned here in the questions is Croda. Is that
Yes.
something you still hold, and what's the outlook for that thing?
Yes. So Croda is again similar trend in sticking with with the natural ingredient category. It has had some very difficult years for the past sort of 2-3 years. That's again coming out of the COVID boom, a lot of destocking. Uh, Croda did not have great visibility on how much inventories were sitting, in the channel, so it got caught in this situation. I think the company has been talking about, has been making changes on that side of things, getting a better grip of inventories, trying to sort of, it's had this issue with under absorption of fixed costs. So we have started seeing in the last quarterly results, things getting better. But yeah, it has been quite a difficult time for Croda, but that's also potentially the opportunity, because ultimately we still believe this is a good franchise. It's had some issues, but yeah, as the latest result suggests, things might be getting better.
Brilliant, thank you. Now I know there's a slide in here later on which just shows you what's been driving the returns.
Yes, it's
There
slide
we go.
20.
Cool, year to date. Can you just sort of talk us through a couple of these, please? It's just kind of interesting to see what's going on.
Yeah, so I mean, I would say general comment on the positive contributors is that we have a lot of more resilient business models. I mean, starting from the top, Sabesp, water utility in Sao Paulo in Brazil. What's interesting, by the way, is that Sao Paulo has had a long history of dealing with droughts, going back to my point around water scarcity at the beginning. So it's very important, to have a company like that that knows how to deal with, sort of boost the water network there. But why has it been strong this year is that Sabesp is getting privatized, so there is a big opportunity to, improve margins, get the organization running more efficiently. So that's why the share price has been strong. Then second company is Coway, making point of use water purification products. It's a Korean company. So why has it been strong? I would say, very strong position in its core market in Korea. So gaining even more share in that market. That's because they have a product that's better than the competition. They're also, been getting better in selling this product internationally, key end markets like Thailand and Malaysia, so seeing strength there. And then third point is that they're getting more shareholder friendly, returning more cash in buybacks, dividends. So all these three things together, have explained the strong share price performance. Then Shenzhen Innovance is the holding I was talking about before, China company that we have now exited, but it did benefit from all this excitement around humanoid robots. So valuation got to a point where it was no longer very attractive, so we moved on from that one. Um, but yeah, if you go a bit further down, American Water Works, again, utility in the US. At the very bottom, Veolia Environment, that's a water and waste utility we've added earlier this year. So nice to see that doing well. So generally, the theme here is that some of our more resilient business models are delivering good performance. Now, in terms of what's not working, I would say, we have some, if you see these names, it's mainly reflecting concerns around economic outlook. And also some of our digital infrastructure names, that have been delivering very strong performance for the past 2-3 years are giving some of that back. A good example is PTC at the very top of that list, software company used by industrial engineers to design products, monitor their manufacturing, and then service them better in the field with digital twins. So it's interesting, if you look at the performance of PTC for the past 3 years, looks very strong. But if you read the commentary, they're saying that we've been operating in an industrial recession environment for almost 2-3 years now. So very resilient business model, still very tough end market, and add on top of that the noise around US recession, tariffs, etc., that explains some of the weakness. Generac and Littelfuse, again, a bit of tariff noise. Generac has sources some of its components from China, so that created a bit of short-term uncertainty. And then, Generac makes backup power generators, which one could say is a discretionary product. So in a recessionary environment, people might not be buying it as much. But, we're talking about the US, where we have wildfires, power outages every few months. So, they're only discretionary until the next power outage when thousands of people are without power in their homes. And then Littelfuse does have some automotive exposure. Again, automotive market is probably the eye of the storm around sensitivity to economic cycle, tariffs. So that explains some of the weakness there.
That's great. Thank you very much.
Of course.
One more question that we could just get answered, I think, while we just there's just enough time. Would you hold anything that could be considered like a dirty company because it contributes to the environmental story? And I'm guessing probably the implication underneath that is something like a mining company producing essential minerals, that's that sort of thing.
Yes. So going back to how I was explaining the thesis behind IEM in the beginning, we are investing in pure play solution providers. So any company that has more than 50% of its revenues contributing to positive solutions in environmental markets is eligible for the universe. Then, our bottom up, that makes it eligible, doesn't mean that we would automatically own it. Then comes the fundamental analysis, looking at corporate resilience. We haven't owned a mining company so far, but that's not to say we would never do that. Again, it comes back down to getting confidence around, is this a good operator? Is it managing its risks appropriately? And, properly understanding also what's the outlook for the whatever commodity it is that they are mining. So, it depends, but they're eligible for the universe, I would say.
Brilliant. Thank you very much indeed. We've covered a lot of stuff here, and I think we've answered most of the questions. So we'll probably wrap it up there. But thank you very much for your time this morning.
Great. Very nice to talk to you and to all the audience.
I'm going to make sure you get a chance to freeze on the mornings because that's very important. And thank you, Andrew. Thank you, Fotis. We'll be back next week, and we've got the managers of Global Opportunities Trust in. And I do think this is an interesting fund. It's doing something very different, and they've got an interesting story to tell. So have a good weekend, one and all, and I will see you next Friday.